Hello and welcome back to the notes. Today I'd like to talk about the varieties of value. I wrote a column about this last week which has attracted a lot of interest, so I thought it would be worth going through it on video. Now, everybody agrees that there is a value effect. This was nailed down by Gene Farmer, who won a Nobel Prize for economics last year. In other words, in the long run, stocks that are cheaper when you buy them do in the long run outperform. The question is, where does that value effect come from? Now, Mr. Farmer himself suggests that it's about risk. Stocks are cheap for a reason, because they are riskier. For example, if you want to buy BP in the middle of its problems in the Gulf of Mexico, you would have done very well, but you would have needed a lot of courage to do that. So on that measure, you could call that kind of value effect brave value. Other people think that the value effect actually comes from human behavior, that there is a natural tendency not to be excited, in fact to be bored by quiet companies that without great excitement compound their dividends year after year and have a nice safe balance sheet. You could call that patient value, because in the long run those companies also outperform. Now, Andrew Lapthorne of SocGen very handily created indices to capture both those effects. Let's start by taking a look at brave value. This is where he's taken the 200 cheapest stocks in the MSCI World Index, judged by various different valuation metrics. And you can see that over the long term it really does beat the market very impressively, although it obviously had quite a serious reverse during the crisis. Now let's take a look at patient value. This is also, you could call it quality income. These are stocks that have been screened for their strength of their balance sheet and for the consistency of the dividends they pay. Now what's particularly interesting is when you put those two measures of value together. And you can see that they're almost mirror images of each other. They both value in some form. They both involve buying cheap companies, but they're very different. If you put them both together, however, you get a very smooth ride, and as we can show you here, that combination of the two value effects very handily beats the market, and amazingly it even does that with lower volatility than the main market. Obviously a very interesting concept at work here. Now, one of the critical points is, how will it perform in a serious down market? Let's take a look at how the indices compare to the market in big ups and downs. And you can see that, yes, in a down market, you will expect brave value to underperform. This is not a strategy to take on unhedged unless you can take quite a significant drawdown risk. It's also quite interesting, if you're more interested in trying to do some stock picking, in looking where these different kinds of value are to be found. If we break things down by sector, as we're doing here, you can see that by far the most brave value is to be found in financials. A lot of financial companies look cheap at the moment. Obviously, you need to be fairly brave to invest in them. Now let's do that same exercise for geographies, and again there's a very clear winner when it comes to brave value. The stocks that look cheap but might be a little riskier tend very much to come from Japan. Even after the very big run-up they had last year as people got excited about Abenomics, there are still a lot of stocks that look cheap in Japan if you have the courage to bet that Abenomics will go through and work out. So, I think this is an extremely interesting concept. It's a very good guide to any attempt to beat the market. Beating the market is difficult, but if you harness both these value effects, it does look as though in the long run it might be possible.